You will never believe how much you're paying in rent and how that can get you right into your own home. That's today's video. Hi, welcome back to the channel. I'm Michelle Carolla, realtor here in Madison, Wisconsin, and in Florida. I am joined today on Living a Midwest Life with our resident mortgage expert. We're talking about something super important, and you were never going to believe the numbers behind this. This is Ryan Brown with Fairway Mortgage. Thanks for coming back to the channel.
Yes, thank you so much for having me.
You're always so full of information, such great information. So we appreciate it very much.
Thank you.
So today we are talking about renting. Okay, this is going to maybe blow your mind when you hear these numbers, because when you're in a rental situation and you're paying that rent every month, it might not be right in the forefront of your mind about how much you're actually spending and how you can get into those homes that you're watching all the time on those channels. You can do this too. So you're going to break down all of this for us today, right?
Absolutely. Today is all about first-time home buyers.
Okay, this is such an important topic, such a fantastic topic. So settle back, get some coffee, get some tea, get whatever you want to drink. You're going to learn a lot today. We're going to start with how much you're currently paying examples and how that can go towards a home.
Absolutely. So I talk to a lot of first-time home buyers, and when I talk to them, one of their biggest hesitancies or one of the things that they're scared of is going to be their mortgage payment and how much it costs. And I have them do this exercise where I quickly ask them how long have they been renting, where are they renting, I go through, find out a little bit more about them. And then I have them calculate how much rent they've paid over the last 5 or 7 years. And so many times it quickly adds up between $80, $90, $100, $110, $120,000 that they've just paid in rent.
Now think about that for a second. You're paying rent, right? So you're paying someone else's mortgage. Yes. You're paying someone else's investment. Yeah. Good for them, right? Yeah. Not for you. And if you are sitting there thinking, I want my own home, I want to get into my own home, I want to go ahead and do all these things that I see on these channels that I binge all the time, right? Decorating and getting that investment and having that stability there. Even if you sell it in a year or two, it's still better than paying rent, right?
Oh, absolutely. Yeah, home ownership is a proven way of building equity and building wealth, long-term wealth especially.
That's right. And as an agent, that's what I guide my clients to as well, is that when you're getting into your own home, yes, there are expenses that you don't have when you rent. There is a give and take there. If you do own the home, yes, all of those expenses of those late night calls come to your pocket, right? Yeah. Not to the landlord or to the owner. But at the same time, the offset of that with building that equity, with having that leverage product, right? With having those types of things that you gain from home ownership, tax write-offs, all of the different aspects really do outweigh that. So I don't want people to get stuck on that. A lot of people get stuck on that.
Absolutely. Nope. It consistently, home equity and home ownership is the biggest source of equity and the biggest source of wealth in the United States. More people have more money in their home than anywhere else, than banks or investments. So it's it's a great way to build wealth for the future. Okay,
so now that we've established that, you need to get out of that rental and get into your own property, which we were happy to help with, by the way. Yeah. Oh, and let me just remind you, Ryan has been on the channel several times, so go back and watch some of his earlier videos about credit, and we're going to talk about that a little bit more too, but about loans and all the different aspects of getting into a home. He's full of that information, and the videos are here for you to watch. So, so let's get started today with, so we've talked a little bit about the difference in what you're paying in rent versus how that could go $100,000 towards a home. That's a big chunk towards getting into a home. But then we also want to talk about how to qualify for a mortgage, right? That's a little scary for some people.
Absolutely. So a lot of people are scared of the process when it's really fairly simple. So when we're looking at your loan application, there are 6 sort of metrics or 6 factors that we look at.
Okay.
So it's going to be your income, your credit, your debts, your employment history. We're going to look at the actual property that you're interested in purchasing, and then sort of your cash to close are going to be those 6 major factors that we're looking at when we're looking at your loan application. Okay, not too complicated, but just part of the process. Absolutely.
Right, so let's get started with that first one then. I guess would be the income, right?
Income, yep. So there are 2 kinds of income. So salary is sort of the gold standard when it comes to income. You don't need it to purchase a home, but salary is going to be our easiest way to get you qualified. We can use that income from day one. So if you're a new grad and you've just got a salaried position, we can use your income actually up to 60 days before you start your new job. So even with that offer of employment, we can get you qualified. So there's going to be no employment history needed. Salaried income we can use right from day one.
That's a good point, though. Let me just hit that, because a lot of people are transferring right now across the country. People are moving and getting into different areas. So you're thinking, well, I'm at a brand new job. How can I qualify for a mortgage? That's not the case.
Not the case. If you were salaried, we can use that income right away.
Okay, perfect. All right.
And so then the second type of income would be your variable income. So this is going to be commission, tips, sort of hourly pay. This does require a little bit of history. So usually we look for at least 2 years. It does not have to be with the same employer, but we typically look for the same industry. So you could have changed jobs, but as long as you're in the same industry, we can usually make that work as long as you have 2 years of history of that.
Okay. All right, then. And then just keep rolling us through the different steps.
Sure, absolutely. So after we take a look at your income, we would then take a look at your debts. And so in debts, there are 2 sort of ratios we look at. So we look at all of your potential housing costs. So the home you're looking at purchasing, we add up all the costs of that, and then we add up all of your debts, including your housing costs. There are 2 numbers we look at when we are looking at your application. So with your housing debt, so that first ratio we're looking at, ideally, when you add up your principal, so that's going to be your principal payment, your interest on that payment, your taxes, and your homeowner's insurance. So those 4 things, we like to keep that below 36% of your gross income. So when you look at your check, before all of the taxes and all of your deductions are taken out, that's going to be your gross income. We want your housing to be less than 36% of that.
And like you said, it's not just the payment, it's the whole housing cost.
That is correct. Principal, interest, taxes, and insurance.
Okay.
So that's sort of that first ratio. Then the second ratio is we take all of your other debts. So this is going to be your student loan payments, your credit card payments, your car payments. When we add those to your housing debt, we like that to be less than 50% of your total gross income.
Okay. All right. So that's pretty straightforward, really. Yeah. And that's where you can sit down with someone and just knock all of that out right away.
Absolutely.
And you can just see where they are. So say they're a little upside down.
Yeah, absolutely. So there would be different ways that we would attack that. One would be either paying off debt. A lot of times with student loans, you can get those into deferral status. And as long as you can get those deferred for at least 3 years, we can waive them from the payments.
Yeah.
Absolutely, yep. And then, also we could buy down the rate. So this is sort of getting real technical, but one approach that we have is sort of buying down your mortgage rate, sort of paying a little bit more to get a lower rate, to get those payments lower, to sort of offset those debts. And
I think what the point here is that, as you're hearing Ryan say, there are multiple ways of getting a mortgage and getting into that home.
Absolutely.
It's not like it was 30, 40 years ago. There are so many creative products out there that really can fit each person's specific scenario, which everyone's different, right?
Every loan application is very different.
Every real estate deal is different.
Everyone. So it's all about being strategic and sort of looking at the information we have and sort of structuring it in a way that works for everyone.
Okay, excellent. So I don't think that is, once you hear it from someone who's doing this on a daily basis, the expert telling us that this is really what it takes. There aren't any other surprise steps out there. No. There's not this big mystery that can be surrounded around buying a property, especially your first time. It really isn't. It's just sort of black and white, isn't it?
It is. It is very black and white. We have guidelines, and they're written there, and we just have to follow those guidelines. So there's no gray in mortgage lending.
There's no gray. That's right. And then the other thing is, like, say, for example, like we were saying, say you are a little upside down. Yeah. That's not the end of the world. No. It might defer your purchase for 3 months, 6 months, 1 year, 2 years. But if you are working towards that goal, you are still pushing yourself financially in the right direction.
Absolutely.
Right?
Yep. It's always a good idea to work towards home ownership.
Very, very good. All right. So now, once we're into the credit side, where does that leave us? Are we...
Yep. So credit. So after debts, we go into your credit. So we pull your credit score.
Okay.
So most people know what the credit score is, but it's a score that the Fair Isaac Corporation gives you, your FICO score, and they range from 300 up to 850. The lowest we can go in mortgage lending is 580. So as long as your mortgage score is above 580, usually we can find a product that works for you. So a lot of people need help increasing their credit score, and there are 3 things that are really that I I tell people to work on it, and you can never start these too early.
Okay.
So one is going to be your payment history. This is the biggest part of your credit score. It's making your payments on time. No matter, always make your minimum payment, always make it on time. I always recommend people, when you get a credit card or a student loan, set it up to make that minimum payment automatically. And then if you choose to pay a little additional principal, do that. But making those payments on time, always the minimum, is 35% of your credit score. So that's going to be the biggest part of your credit score.
That's huge.
It is huge.
Okay.
Absolutely. The next biggest part of your credit score is going to be your amount owed. So when you look at your total available credit line, they don't like you to carry more than a third of that balance. So let's just say, you have a $10,000 credit card. If you have more than $3,333.33 on there, it's going to start eating away. Your credit score is going to start decreasing. So always keeping the balance you carry less than a third of your available credit. That's going to be 30% of your credit score.
Okay, so we're up to 65% right now.
Absolutely. And so then the next biggest part is going to be your length of credit history. So that is sort of maintaining those accounts for a long period of time. So that's 15%. So never too early to get those credit accounts open and hold those, because 15% of that is your ability to manage that credit over a long period of time.
Right. And as I hope most people know by now, but if you're just now getting into this and this is new to you, maybe you don't, but if you, have a card that you're no longer using, don't close it.
Do not close that. Keep that open with a zero balance. That is the best thing you can do for your credit. It's a great thing.
Yes, absolutely. Okay. All right. So we have gone through debt. We've gone through credit. Yeah. We've gone through income. Yeah. Where does that leave us?
Yep. So we're going to touch briefly on property. And so property, when we're looking at the property and looking at the subject property, they usually cannot be in a state of huge deferred maintenance. So if you're if you're interested in a home that's like all the drywall's ripped out and, it was sort of, someone started to remodel it and then stopped halfway through, that'll probably be some red flags. So the property has to be in decent shape. So, if you could live there as is, that's usually a good start. That's usually what I tell people to look for.
Now, what if, though, they want to get into a property that would be a fixer-upper?
Absolutely. There are certain programs for that. We have FHA has a rehab program that we could get into the specifics of that. So it doesn't necessarily rule the property out, but it does limit the programs that we'd be able to use, and we'd have to look at those on a case-by-case basis.
Because a lot of times if you are a first-time home buyer and maybe you're in your 20s and you're thinking about getting into real estate investments, that is a wonderful way from the agent's side is to get into a fixer-upper. Absolutely. And if you can get that type of loan, get you into it, and get that built-in equity right away, you are setting yourself up with that first-time purchase exactly where you need to be.
Absolutely.
Right?
Yeah.
And so are there other, just quickly, I know we're sort of going to go off topic just a tad, but if someone did want a fixer-upper, because this is a really good subject for first-time home buyers, if they did want a fixer-upper and they did qualify for the FHA loan, and we can talk about all the different loan types in another video as well, but is there such a thing for the construction side, like a construction loan, or how would they pay for these repairs?
Absolutely, yep. So FHA, a lot of the funds are escrowed, so you would get estimates for any of the repairs that needed to be done ahead of time, and we would set those funds aside in escrow. And then you would sort of slowly make those repairs and pull money from escrow in order to make those repairs.
Okay, so that's a big topic right there. Maybe that should be its own video, is fixer-uppers and how to get in and out of those, because that's so fantastic.
Yes, and there's a lot of detail that goes into those, so yes.
Yes, okay, we'll do that. We will do that. Look for that coming up in a couple of weeks. But back to what we're talking about now, more towards conventional loans, but there are other types of products as well.
Absolutely. So we have lots of different options here in Wisconsin, everywhere. But the three that I typically put most first-time home buyers in it's going to be a conventional loan, an FHA loan, or a WIDA loan. Those are going to be the three big ones.
I'll break those down for everyone, because they might not even know what WIDA is.
Absolutely. So that's the Wisconsin Housing Economic Development Association. So it's a local a local organization here in Madison that they encourage home ownership. So their goal is to get people into homes. And so the big thing about WIDA is we can get you into a home with 0% down. So you actually have no money that you need to bring to closing, which is huge.
That's massive, because a lot of people watching will probably say, well, I'd love to get in a home, but I don't have a big reserve of cash.
Absolutely. And so how WIDA works, it's actually it's a conventional loan. with 3% down. So you're actually qualifying for 2 loans at the same time, which sounds scary, but it's not. You're getting 2 loans at the same time. One that's going to be a 3% down loan, and then you actually get a loan for 3% down for your down payment. So it actually, you bring nothing to closing and you qualify for them both at the same time. So the 3% is going to be your down payment assistance loan.
Yeah, that is super helpful for a lot of people.
Absolutely.
Okay.
Yes, and then so conventional, that's where the majority of people fall. If you have decent credit, and if you can come up with at least 3% down, this is going to be your best option. You're going to have the lowest rate, and we're going to be able to move the quickest on a conventional loan. So these are going to be your standard Fannie Freddie loans at 3% down. So if you go as low as 3% down, it does require a first-time homebuyer's education. So you would have to participate in an online course that you do, and they'll get a certificate at the end, and you send it to us. But it's a great way to get into a home with only 3% down.
That's good. And you're getting a lot of great information, and it's not a difficult course at all. It's just informative.
Informative, absolutely. Everyone loves that course. And then FHA would be another program that we put a lot of people in. And FHA is going to be beneficial to you if you have a slightly lower credit score. We're able to get people into FHA loans if they have a slightly lower credit score. So these are going to be these people that are more high 5s, low 6s is usually where we focus more of FHA. FHA is as low as 3.5% down.
Okay, and that's the Federal Housing Authority, and so that's a government-backed loan.
That's a government-backed loan, absolutely.
Okay, and as you can see, when you start getting into the mortgages and the loan types and everything, that starts to, maybe some people are like, oh, I've lost it, I don't know what we're talking about, and some people are like, oh, okay, that seems a little clear. But that's what Ryan's for. That's what we're here for. When you are really getting serious and wanting to get into a property, reach out to me, reach out to Ryan. I'll put his information in our description, of course, and we can sit down and have a chat with you about this. We can work together on finding the property that best suits you, best suits your current needs, as well as which product is going to be the best for that particular property.
Absolutely, absolutely.
Okay.
And another big topic, another big question I have when first-time home buyers is how much cash do I need to close? We sort of talked about down payment requirements when we were talking about the loan programs, but closing costs is another big question. Mm-hmm. And so I'd like to sort of just talk a little bit about closing costs, prepaids, and cash reserves.
That's time to listen up, because there really are 2 buckets of money, right?
Absolutely.
There's that getting into the deal money. There's your, whether it's your escrow and your loan deposit, your loan down payment, but there's also the money that you need to get the key.
Absolutely.
Okay.
Yep. So there's that down payment is sort of one bucket. The other one is going to be your prepaids, your closing costs, and your cash reserves. So depending on your loan program, cash reserves are cash the lender wants you to have when you close. So it sort of varies by loan program. The most common is 2 months. It can go as low as 0 months, but that's like they want to see up to 2 months of your mortgage payment in the bank still after closing. So after you bring all your cash to closing, they'll want 2 months. So some programs are 0. The most common is 2. Closing costs. So here in Wisconsin, I always recommend estimating about $2,500 for closing costs.
Okay. So
this is going to be sort of your title fee, your title insurance for the buyer's side, all of the title fees, your underwriting fee, your admin fees. $2,500 is a pretty normal fee for a closing in Wisconsin.
Okay.
Prepaids are going to be sort of prepaid taxes, so your prepaid property taxes and prepaid homeowners insurance. Most programs, it's going to be 3 months of property taxes into escrow. So if you take that whole tax bill, if you look at a property tax bill, divide it by 12, we want about 3 months in escrow and then 2 months of homeowners insurance prepaid. And the reason taxes are a little bit more is because you usually don't make that first payment. So when you close, your first payment usually isn't due for 60 days, but at the same time, your taxes are still due. So we require that 3 months. So we have that 1 month buffer where you're not making a payment, and then we keep the 2 months in escrow for the property when your taxes are due.
Okay, and again, like always, most of the things we talk about, there are a lot of numbers being tossed out, right?
Yes.
And it can get confusing when you're just watching a video and listening to it and not writing down all of these notes, but you don't need to do that. No. It's really not complicated. It's very, as we said earlier, very black and white. Absolutely. There's no gray area, and that's what we're here for. We can break all of this down for you and basically just have a consult, right?
Absolutely.
See where you are at the moment and where, what's your starting point, and are you ready to go, or do you need a little work here and there, and then just sort of launch that process?
Absolutely.
Okay. Well, again, lots of info. Ryan's info will be in the description. My info is always in the description. So thanks for all of this. This is super great.
Yes, thank you so much for having me.
Yeah, well, you know, and like we started out, if you forgot all after what we started with, it's like if you're sitting there paying that rent every month and you're paying between what, say $1,500 if you're in more of a metro area, and then in the Madison area, especially the downtown, if you're in like the center core, you're paying well over $2,000.
Absolutely.
Right?
Yeah.
So that's 80 to what, $100 and some $1,000?
120, 140, depending on your rent in just 5 years. So in 5 years, you could be paying as much as $140,000 easy in rent.
And think about the price of a home. That is a huge chunk. That is a huge getting into as far as like your down payments and everything. You can save so much, you know, with not paying that rent
That's
so
exactly
quickly.
Right. Absolutely.
Oh my goodness. Okay. Well, thank you. As always, go back and watch some of his other videos. If you haven't subscribed and you're new to the channel, be sure to hit that subscribe button and the notification bell. We do put out new videos every Friday at 4 o'clock Central right here on Living a Midwest Life. We'll see you again next time.